Hello. Welcome to this week's Private Funds Update. I'm Sandra from SmartEsq. Here's what I learned this week. We start with a structural shift that finally brings a roadmap to digital assets. The two-lane highway is now law under the Clarity Act. The act was passed in the final weeks of 2025 and became effective on January 1st, 2026. It marks a decisive end to the industry's gray zone. For years, that gray zone was defined by regulation by enforcement. The SEC's broad application of the 1946 Halley test meant almost every token was treated as a security. This resulted in a freeze of the IPO market for crypto-adjacent portfolio companies and leaving hedge funds guessing on compliance. This new law settles the jurisdictional war by codifying the split. The SEC regulates digital securities, while the CFTC takes digital commodities. For private equity, this is an exit story. It provides the statutory certainty needed for public listings. For hedge funds, the impact is immediate. By moving digital commodities into the CFTC's lane, traders gain access to a more established institutional framework for leverage and custody. As CFTC Commissioner Selig noted in a statement on January 20th, the agency is now moving quickly to provide the oversight necessary for deep institutional liquidity. The risk of a surprise enforcement action for trading a gray zone asset is finally receding. Next, a critical compliance change for funds with international exposure. For decades, the norm for foreign private issuers, or FPIs, was a total exemption from Section 16. To be clear, an FPI is a non-U.S. company listed on a U.S. exchange that maintains a majority of its shareholders and assets outside the United States. Think of the Brazilian tech firms, Israeli software shops, or European biotechs that list in New York. Historically, if your fund held a 15% stake in one of these, you didn't have to report trades, and you weren't worried about the short swing profit rule. That exemption went away this month under the Holding Foreign Insiders Accountable Act. If you hold a 10% stake or a board seat in an FPI, you are now a Section 16 insider. This means you have a 48-hour window to file Form 4s. And any profit realized from a purchase and sale within 6 months must be disgorged to the issuer. To comply, managers will need to audit their global portfolios to identify FPIs where they hit the 10% or board seat threshold. You'll need to secure EDGAR codes for your insiders now, not when you're ready to trade. Most importantly, you must implement a strict pre-clearance process. In this new regime, a simple rebalancing trade could inadvertently trigger a massive 16B liability. Finally, we turn to AI. On January 1st, comprehensive AI laws went live in Colorado and Utah. For private funds, this creates a due diligence burden that contrasts sharply with the EU's AI Act. The EU regime is a horizontal product safety framework that regulates the technology itself, categorizing AI by risk tiers across the entire European Union. In contrast, the new U.S. state laws are outcome-based, focusing on algorithmic discrimination in specific sectors like lending, insurance, and hiring. For a private fund, this means your due diligence must be hyperlocal. A portfolio company's hiring algorithm might pass the EU's technical transparency tests, but still trigger a civil rights violation in Colorado if the outcome shows bias. We are seeing a divergence where the EU regulates how the tech is built, while U.S. states regulate how it is used. That's it for this week. You can learn more about these topics from me on the SmartEsq platform. If you are curious about the services we offer, please visit www.smartesk.ai.